Right now, as we watch the markets unfold on this Tuesday, December 2, 2025, Polyrizon Ltd., ticker symbol PLRZ on the Nasdaq, is trading at precisely $6.39 USD. That represents an intraday explosion of roughly $3.23 per share, translating to a massive gain of 102.12% in a single trading session. If you are looking at your screen wondering if that decimal point is in the wrong place, it is not. This is one of those rare, violent market dislocations that catches almost everyone off guard, specifically because the company has been relatively quiet until now. Most investors scanning their Fidelity mobile app or checking the Robinhood stock trading lists this morning probably ignored this ticker initially, assuming it was a glitch or a low-volume pawn. But the volume tells a different story. We are seeing millions of shares change hands, turning over the float multiple times, which indicates that this is not just a retail pump, but a structural repricing event driven by a specific, tangible catalyst that hit the wires earlier today. When a stock doubles in hours, the immediate expectation is that it must be a buyout rumor or a sudden FDA approval, the kind of lottery ticket event that traders on SoFi Invest constantly hunt for. The reality, however, is far more nuanced and, frankly, more interesting from a market mechanics perspective. The reality is that Polyrizon has executed a classic bear trap by releasing significant operational news mere days after a reverse stock split, catching short sellers in a liquidity squeeze that is fueling this vertical move. The narrative expectation for a company like Polyrizon, a small-cap biotech firm, is usually grim. The sector is littered with companies that burn cash, dilute shareholders, and eventually fade away. The general market belief, the expectation, was that following their recent 1-for-6 reverse stock split, which became effective just last week on November 28th, the stock would continue to drift lower. This is the standard playbook. A company splits its stock to stay listed on the Nasdaq, and predatory algorithms smell blood, shorting the new higher-priced shares in anticipation of further dilution. Traders using Interactive Brokers trading terminals often set up automated strategies to fade these post-split rallies. But here is where the reality pivots sharply away from that expectation. Polyrizon did not stay quiet. Instead, they dropped a major announcement regarding a manufacturing upscaling milestone for their PL14 nasal spray platform. By validating that they can move from small lab batches to large-scale controlled manufacturing, they effectively removed one of the biggest technical risks facing early-stage biotechs. The market expected a paper tiger struggling to survive. The reality is a company that just proved it can produce its product at scale, triggering a massive reevaluation of its enterprise value. This divergence between the bearish post-split expectation and the bullish operational reality is the precise fuel behind today's 102% move. To understand why this move is so violent, we have to look at the market structure. When you look at widely held assets like Tesla stock or Apple stock, there's a massive ocean of liquidity. $1 billion entering Nvidia stock moves the needle, but it doesn't break the machine. However, Polyrizon is a different animal. With the recent reverse split reducing the total share count, the float, the number of shares actually available for trading, is incredibly thin. When positive news hits a low-float stock, the supply of shares effectively vanishes. Retail traders on Robinhood investments platforms see the percentage gainer list, jump in, and overwhelm the sell orders. Simultaneously, the algorithms that were shorting the stock post-split are forced to cover their positions to prevent catastrophic losses. This creates a feedback loop. The price goes up, shorts buy to cover, which sends the price higher, which attracts more retail buyers on SoFi investing apps, which forces more shorts to cover. It is a perfect storm of supply and demand imbalance. If you manage your own funds through Schwab Intelligent Portfolios or similar online investment tools, you rarely see this level of volatility because those portfolios are designed to dampen it. But for the active trader, this is the rawest form of price discovery. It is chaotic, it is fast, and it is driven entirely by the realization that the company is technically further ahead than anyone gave it credit for yesterday. Let's discuss the actual catalyst that sparked this fire. The news today centers on the PL14 formulation. Polyrhizin is not trying to cure cancer or fix heart disease. They are working on biological barriers. Their proprietary Capture and Contain platform is essentially a hydrogel nasal spray. Think of it as a biological mask that you spray into your nose. The expectation for this kind of technology is skepticism. Is it just fancy salt water? But the reality, substantiated by today's manufacturing news, is that this is a complex hydrogel that creates a thin, invisible shield over the nasal mucosa. This shield is designed to trap viruses, allergens, and other pathogens before they can infect the body. The upscaling milestone announced today means they have figured out how to make this complex gel in large quantities without it losing its stability or effectiveness. This is the valley of death for many biotechs. They have a cure in a test tube but cannot make it in a factory. Polyrhizin just announced they have crossed that valley. This puts them on a direct path to clinical trials in 2026 with a product that can actually be mass-produced. For a speculative investor using Fidelity brokerage services to research microcaps, this de-risking event is huge. It transforms the company from a science project into a potential commercial entity. The sheer volume we are seeing today is also worth analyzing deeper. A stock does not trade 100% on thin volume. It requires a turnover of the entire shareholder base. We are likely seeing a rotation from stale holders, people who have held the stock for months and are just happy to get out at a higher price, to momentum traders who are betting on the next leg up. This is common behavior observed on investing sites and forums where retail sentiment is aggregated. The chat rooms are likely buzzing with comparisons to other recent biotech runners. But unlike a meme stock that runs on pure sentiment, PLRZ is running on tangible progress. This distinction is vital. If you are using SoFi Active Investing to play this, you have to recognize that the floor has essentially been raised. The company has proven a capability today that it did not have yesterday. That creates a new valuation baseline, even if the intraday price creates a temporary overshoot. The volatility is stressful, but it validates the thesis that the market was mispricing the asset. I want to pause here and ask you a question about the product itself, because the science is actually quite intuitive. Comment below with your thoughts. Do you think a spray-on mask could ever replace or supplement physical masks in a future pandemic scenario? Or do you think the public is too skeptical of putting gels in their nose? I am genuinely curious to gauge the consumer sentiment here, because that is ultimately what will drive the long-term stock price. Moving back to the analysis, we need to consider the broader ecosystem. When Fidelity Investments or Interactive Brokers stock desks see this kind of action, risk management protocols kick in. Margin requirements are raised. This makes it harder to short the stock, which paradoxically can fuel the rally further because it removes selling pressure. It is also important to note the sector sympathy. When one biotech flies, traders scan the horizon for others. But PLRZ is unique today because of the specific nature of the news. Manufacturing milestones are boring to the average person, but they are gold to an institutional investor. It signals that management is competent. It signals that the trap and target platform is robust. Institutional capital, the kind managed by Fidelity Wealth Management or large Fidelity mutual funds, rarely chases a 100% intraday move. They wait for the dust to settle. So what we are seeing today is likely a battle between aggressive retail traders and trapped shorts, with institutions watching from the sidelines, waiting to see where the new support levels form. Now, let's look at the financial reality beyond the chart. Polyrhizin is still a pre-revenue development stage company. That is the cold, hard truth. Despite the online investing hype today, they need cash to run the clinical trials scheduled for 2026. This brings us to the Future Outlook section of our analysis, and this is where you need to be very careful. The expectation now, after a 100% run, is that the stock will keep going to the moon. The reality is that biotech companies almost always use these price spikes to raise capital. It is highly probable that in the coming weeks or months, Polyhorizon could announce a direct offering or an equity raise to fund those 2026 trials. This is not necessarily bad. It keeps the lights on, but it dilutes current shareholders. If you are holding shares in your Robinhood cash management account or your Fidelity IRAs, you need to be aware that this spike might be sold into by the company itself to secure its future. This is the tension of the biotech trade. Good news drives the price up, which allows the company to sell stock, which drives the price down, but secures